Triangles are the most common price pattern, but are also one of the least reliable. They come in two varieties, symmetrical and right-angled. Both develop as consolidation and reversal formations. Let's start off by considering the symmetrical variety. They consist of an ever-narrowing trading range, bounded by two converging trend lines. In order for a line to represent one of the boundaries, it needs to be touched on at least two occasions. This means that a triangle consists of 4 turning points, 2 for each line. In reality, though, such patterns are usually more reliable when one of the lines has been touched 3 or more times. Indeed, the more contact or near contact points, the better. In our basic building block presentation, I pointed out that trend lines are nothing more than dynamic levels of support and resistance. Thus, the more times a triangle boundary has been touched or approached, other things being equal, the greater the significance that boundary is as a support or resistance area, and therefore the stronger the breakout signal when it comes. A symmetrical triangle is composed of a series of 2 or more rallies and reactions, in which each peak is lower than its predecessor, and the bottom from each reaction is higher than its predecessor. These patterns are also known as coils, because the fluctuation in price and volume diminishes as the pattern is completed. Finally, both price and usually volume react sharply, as if a coil spring is being wound tighter and tighter, and then snap free as prices break out of the triangle. It's normal for the trend of volume to do the same thing as price, and that is become quieter as the pattern is developing. Activity for a top reversal formation can be anything, but generally speaking, a stronger signal comes with an increase in activity. The classic texts tell us that triangles seem to work best when the breakout occurs somewhere between 1/2 and 3/4 of the distance between the widest peak of the rally and the apex. So if we say that a triangle starts here, and this is the apex, then the 2/3 mark would approximately be around this point just here. Here's an example of a triangle at a bottom. The volume rules used for other patterns are also appropriate for triangles. That means that activity should gradually contract as the pattern is being formed. During upside breakouts, it's probably more important for volume to expand, given the tendency for these patterns to be less reliable. The point here is that the balance between buyers and sellers is becoming more finely balanced as the pattern develops. Then on the breakout, volume expands, thereby signaling from both a price and volume point of view that control has slipped decisively to one side or the other. Most formations give us a clue as to the direction of the ultimate breakout, in the event that they are completed. The symmetrical triangle does not, and keeps us guessing. Here's an example. I've colored it in gray because we do not know which direction it will break out. Since it should be assumed that the prevailing trend is intact until proven otherwise, it's a good idea to take for granted that the triangle will eventually break in the direction of the prevailing trend, as this one did. That is, unless you have strong evidence to the contrary. Clues in favor of a reversal would come if the price was overextended in one direction or the other. This concept is discussed in later presentations covering momentum. Alternatively, it may be possible to observe that many stocks had already begun to break in a new direction. A reversal would be more likely if the pattern formed after the prevailing trend had been in force for a long time than if it had just begun. However, when taken in isolation with no other supporting evidence, the prevailing trend assumption should be applied. Since this turned out to be a bullish formation, I'll change the color from gray to green. Traditionally, measuring objectives for triangles are obtained by drawing a line parallel at the base of the triangle through the peak of the first rally. This line represents the objective that prices may be expected to reach or exceed. The reverse procedure at market bottoms is shown here. The same technique is used to project prices when triangles are of the consolidation variety. However, in my own experience, I've not found this method to be particularly useful, and that's because the actual price move is usually far more than the price objective. I prefer instead to treat the triangle as with any other pattern by calculating its maximum depth and then projecting this distance at the breakout. An example of this alternative method for a top is shown here. By adopting this approach, the principle of proportionality is preserved. Here's the same idea for a bottom, where we calculate the maximum depth of the formation and project it to the upside at the breakout point. There is, of course, nothing to stop prices from moving in multiples of the objective, as with other patterns. Summary: symmetrical triangles. Price characteristics: a narrowing trading range confined between two converging trend lines moving in different directions. Volume consideration: volume contracts as the pattern forms. Upside breakout should be accompanied with expanding volume. Measuring implications: maximum depth of the pattern projected in the direction of the breakout. Alternatively, for bullish patterns, draw a line parallel to the line's lower trend line and anchor it at the initial rally. The extended line becomes the price objective. For bearish patterns, draw a line parallel with the pattern's upper trend line and anchor it at the initial decline. The extended line becomes the objective. Strongest breakouts come from a point between 1/2 and 2/3 of the distance between the start of the pattern and the apex. Signs of false breakouts: weak volume accompanying an upside breakout. Right-angled triangles are really a special form of the symmetrical type, in that one or more of the first boundaries join a series of two or more declining peaks, whereas the second is formed at an angle of 90 degrees, that is, horizontal to the vertical axis. The symmetrical triangle does not give an indication of the direction in which it ultimately is likely to break, but the right-angled triangle does, with its implied slanting level of the upper resistance line. The right-angle variety at bottoms is constructed by taking the line joining two or more bottoms together with a horizontal one. Volume should, of course, shrink as the pattern is being formed. In this way, it indicates a balance between buyers and sellers. Ideally, volume should increase on the breakout, but it's not mandatory, only that it doesn't contract. Like most patterns, triangles often experience retracement moves following the breakouts. You can see that here for a right-angled ascending triangle. If an opportunity is missed on the breakout, the pullback or retracement move offers a second chance, usually under far more quiet conditions. If it's possible to construct a retracement trend line, the upside penetration of the line is a good entry point, since it indicates a reassertion of the original breakout. This is especially true if the retracement move is accompanied by shrinking volume, and the breakout above the retracement trend line with slightly or significantly expanding activity. This 10-minute bar of IBM shows a nice triangle top. Nice because the upper line was touched or approached on numerous occasions, and therefore represents formidable resistance. Nice because you can see a retracement move immediately following the breakdown. Finally, quadruple times the objective is obtained, and that's important because it became support just here, and if we look back, we can see that this level had been the area of an important low. An example of a symmetrical triangle at a top is shown here for Intel. This dashed line shows the traditional measuring approach, and you can see that it did have some significance because it roughly intersected with the lower end of the October gap break to the downside. However, when we take the depth measurement, we can see that the price achieved twice its objective, and that in its own right was an important support level. One of the problems with triangles is that they often trigger false breakouts. This is probably because the trend lines that construct them only require to be touched twice. One filtering mechanism is to only act on breakouts where the trend line being violated has been touched or approached on more than 2 occasions. This will never eliminate all false signals, but will certainly limit them. One of the reasons for failure is that symmetrical triangles, for example, morph into something else, or put another way, a lot of patterns start off as triangles but turn into another formation. Here we see a perfectly good breakout from a triangle. However, as time progresses, the price breaks down from what turned out to be a bearish, upward-sloping, complex head and shoulders top. As always, you need to anticipate this kind of possibility and make the initial decision on whether the risk-reward, by placing the stop just below this bottom at A, is worth it. As time progresses, the extended green trend line, which effectively becomes the neckline of a head and shoulders pattern, is a support level below which you would place a stop. Here's another example of how things can go wrong, as in this bullish triangle breakout, which turns into a trading range, but unfortunately it's a bearish one. In this instance, the stops would involve more risk, as the obvious support point is at A, and as the price moves back below the upper dashed green trend line at B. To the flexible trader or investor, a pattern failure offers a great opportunity. This is probably more true of right-angled triangles than any other formation, since the moves following right-angled breakdowns can often be dramatic. The break for a bullish formation takes place when the price violates the rising trend line prior to a break through the horizontal one. Here's an example where it looks very constructive, as we have a series of rising bottoms connected by a very nice trend line. Confidence rises as the price rallies to the horizontal trend line, but each decline becomes smaller than its predecessor. A move above the overhead resistance indicated by the horizontal line is therefore expected and positions taken accordingly. At the same time, sellers feel quite comfortable liquidating every time the price rises to the line. Since this happens on a number of occasions, there's no pressure to accept a lower price. That is, until the ascending line is violated. Then everybody wants out. On the one hand, the original sellers realize that it's no longer possible to obtain the higher prices associated with the horizontal trend line, and on the other, those who bought in anticipation of the breakout lose heart. Such a rationale explains why such failures are often followed by substantial price moves. This chart of Altera shows a bullish right-angled triangle. Okay, there was a false breakout above the horizontal line, but at the time we're looking at it, that line represents good resistance. There's certainly nothing wrong with the rising line joining the bottoms. That is, until it's violated. Note that initially not much happens as traders digest their losses. They must have known something, because immediately after, the price gaps down on heavy volume. That just goes to show that just because a price does not immediately fall following a violation, that you should ignore it. This certainly demonstrates the power of a failed right-angled triangle. I'll color it in red to emphasize the danger. Finally, here's another example of how powerful these failures can be. This is the Philadelphia Gold and Silver Share Index, bounded on the upside by a horizontal resistance trend line. Then we can draw an uptrend line joining a series of lows. Note that sometimes we have to use poetic license in constructing these patterns, as here is a temporary break below the line. But if you remember from the session on trend lines, a whipsaw break actually increases the significance of a trend line. Rather unexpectedly, this line is violated and a sharp decline ensues. Once again, we'd better change the color from a green bull to a definite red bear for this pattern. Summary for right-angled triangles. Price characteristics. A narrowing trading range confined between two converging trend lines, one of which is at a right angle to the vertical axis. The price is expected to break through the right-angled line in the direction of the sloping trend line. Volume considerations. Volume contracts as the pattern forms. Upside breakouts should be accompanied with expanding volume. Measuring implications. Maximum depth of the pattern projected in the direction of the breakout. Alternatively, for bullish patterns, draw a line parallel to the pattern's lower trend line and anchor it at the initial rally. The extended line becomes the price objective. For bearish patterns, draw a line parallel to the pattern's upper trend line and anchor it at the initial decline. The extended line becomes the price objective. Strongest breakouts come from a point 1/2 to 2/3 of the distance between the start of the pattern and the apex. Signs of false breakouts, contracting or weak volume accompanying an upside breakout. Pattern failures occasionally come with a violation of the sloping trend line. Well, that about wraps it up for price patterns. I hope you can now appreciate how they encompass the basic building blocks we looked at in the first module: peak and trough, support resistance, trend lines, and volume. I think it's important to bear in mind the size of the pattern you're looking at. Tops made with hourly charts may look horrible and give you the impression that the world is coming to an end. However, their effect will have passed within a couple of days or so. Those forming on the daily and weekly charts, on the other hand, will be far more consequential. A final point is that you should always bear in mind the direction of the breakout. Is it in sympathy with the dominant trend or against it? If it's a counter-cyclical move, you are far more likely to run into trouble if you act upon it.